Hi everybody, welcome back to the 10th of an Hour with Griffin Bridgers. For today's episode, episode 113, I'm going to have the first of a few discussions where I dive into just kind of understanding on a basic level the federal gift tax. So really kind of the intent with this discussion and the couple of follow-ups I'll have on the estate tax and the generation skipping transfer tax is designed to just kind of show, without diving into details of code provisions or anything like that, what purpose the federal gift tax fulfills. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, as a caution before I dive into this, I want to preface that the views in this presentation are solely my own views, or the views of Griffin Bridgers, and they don't actually reflect policy documents or research or anything like that. This is really just kind of me boiling down how I explain the gift tax to clients and to students when I teach this material as well. So, to start, I like to preface by presenting the hypothetical, what if there was no gift tax? Well, as we all know, the federal estate tax taxes transfers of wealth at death. There's generous exceptions to that now and exclusions and credits, but we're going to put those aside for now and just kind of look at this as a tax neutral type of thing where we look at estate versus gift tax on its surface. So without a federal gift tax, what somebody could do is say, hey, I'm going to have a big estate tax bill at my death, so I'm just going to give away all my wealth during life in order to avoid that estate tax. And the IRS doesn't like that. They lose out on revenue then. So what the gift tax does is it exists to prevent that outcome of giving away all your wealth during life so as to avoid estate tax. And it's designed to operate generally in a tax-neutral way other than with respect to the time value of money. So the time value of money consideration really allows for you to accomplish the estate tax goal of freezing the value of wealth transfers by applying the gift tax to the fair market value of gifted property at the time of the gift. And we'll talk about that in a few slides. But for the time being, there's exceptions because it would be difficult for the IRS to tax every single gift made during the year. Having come off the holiday season now, imagine the nightmare of having to report your holiday and birthday gifts to the IRS every year, not to mention the lack of privacy that would be involved. So the gift tax in general really is designed and structured to tax large and intentional transfers of wealth during life, and not to tax natural gifts that might be the natural outflow of a relationship you might have with somebody, like holiday or birthday gifts. This is reflected in some of the exceptions that we've talked about in previous episodes. One is, the gift tax annual exclusion, and the exclusion for direct payments of tuition and medical expenses. Both of those exclusions reflect an intent not to tax gifts that are really just incidental to the relationship and are not driven by a significant motive to save estate tax. We also have the fact that future interests don't get the annual exclusion and are taxed on every dollar. Similarly, any transfers with retained interest that are taxable could also be subject to the gift tax. So what these carve-outs do is they acknowledge that lifetime transfers and trusts, especially with a retained interest, are really just transfers that are more testamentary in nature. In other words, they're reflecting what would otherwise have been a transfer at death, which is really just being made during life for the purpose of trying to remove the growth and value of the property from the estate tax. And if you fly too close to the sun and try to retain too much control of that, the IRS isn't going to respect that you've fully given away that property from a gift and estate tax perspective. Now we're going to look at how the gift tax shoehorns into the income and estate taxes, but for the time being it's important to note that the gift tax is tax exclusive, which means it does not reduce the value of the gift. In other words, the gift tax, if it's paid, is paid in addition to making the gift by the donor. So the benefit here is that usually if you pay somebody else's tax liability, that would also be a gift to them or would also be income to them. But in this case, the gift tax paid by the donor or income tax paid by the grantor on behalf of a grantor trust would not be treated as an additional gift because the gift itself didn't shift the responsibility of taxation from donor to donee. And that shifting of responsibility is going to be a subject that comes up when we look at income tax. Now, there's a progressive nature here. If you look at the gift tax rate table, which also applies to estate taxes, the rates are progressive. They start with a 10% rate, move up to a 40% rate. And it seems, looking at that you could structure your gifts to keep yourself in the lower rates throughout life and still obtain an advantage over the estate tax. But you cannot structure gifts to use the lower rates because the gift tax is incrementally calculated on your year-over-year increase in your cumulative lifetime taxable gifts. That means the next year that you make gifts, it's going to bump you up into higher rates, and it's going to keep bumping you up into higher rates, and you're only ever going to calculate gift tax on the difference between what you've given away previously and what you've given away cumulatively, including this year's gifts. And your rate is always going to correspond to the difference in tax between those two sums. So this is designed again to capture transfers that purposely reduce estate tax, and also giving Congress the leeway to increase gift taxes in the future and indirectly apply those maybe to past gifts when you have to reconcile those two amounts. But at the same time, since the estate tax rate table uses these same rates, this is a unified tax between the estate and gift tax. And it's designed to remove, other than the time value of money, any incentive based on rate arbitrage to give away wealth during life versus giving away at death when there's a rate differential maybe between gift and estate taxes. So when it comes to the income tax, as you may know or you may not know, gifts and inheritances are not subject to income tax on the recipient. Now there's some restrictions in there where you can't necessarily shift earned income or service-related income to another taxpayer, by gift or maybe through IRD and other things we've looked at, but generally a gift is not subject to income tax. But really all it does is it shifts the burden of wealth transfer from the transferee to the transferor when it comes to the tax. So in other words, the income tax is not there, but it's replaced by the gift tax. Now it's important also to note that generally the income tax only applies to the appreciation in the value of property, while the gift tax applies to the fair market value of the property at the time of death, or at the time of the gift. So for appreciated property, that means that both the basis in the property and the appreciation are subject to gift tax. So that's kind of hard to wrap your head around, that basis is subject to gift tax. But if you have depreciated property, it means only that a portion of the basis is ultimately subject to the gift tax. So with this, you avoid a double tax if gift tax is actually paid out of pocket, because the basis of the gifted property, which is usually a carryover basis, can be increased by the gift tax that's paid out of pocket, proportionate to the portion of the taxable gift that reflected appreciation in value. Otherwise, without that, then you'd have a gift tax on appreciation that's also taxed when the donee turns around and sells the property. But you cannot gift a tax loss to someone else, because for depreciated property, the gift tax only applies to a portion of the basis. That means the excess basis over the fair market value is not subject to gift tax and also cannot be used to create a tax loss by the donee. So the donee can only deduct a loss accruing while they own the property. Now when it comes to estate tax, it's often thought of that you use up your applicable credit against gift tax during life, and that reduces the amount that's available for estate tax, but it's not. You really get a full reset at death, because your estate tax applies not only to your taxable estate at death, but also to your adjusted taxable gifts. So this cumulative calculation also gets wrapped up one final time into your estate tax return as an adjusted taxable gift figure. Now, the difference here is that you get your full applicable credit amount on the combined taxable estate and your adjusted taxable gifts. And from a valuation perspective, now, your adjusted taxable gifts are adjusted because you might have some retained interests that are taxed at their date of death fair market value, but the adjusted taxable gifts bucket will use the date of gift fair market values, thereby preserving that time value of money planning component I referenced earlier. There can also be a credit for gift tax paid out of pocket when you compare it to what the estate tax would have been, and that gift tax is higher than if you had just waited and paid it or not paid it at death based on the applicable credit amount. Yep. And now if you use your applicable credit amount during life and it's later reduced, you can still get the exclusion that was available at the time of the gift, to the extent that exclusion was used. So with all of this, the ultimate objective of gift tax planning is preserved, that you get to freeze the value of transferred assets for estate tax purposes. Now, I'd be remiss if I didn't mention comparison that the estate tax is tax exclusive, because it has to be. You're drawing the tax from a finite pool of assets. However, gift tax paid out of pocket, other than within 3 years of death, will reduce your estate and thus your estate tax. However, gift tax paid out of pocket within 3 years of death is pulled back into the gross estate and is subject to estate tax after deductions. I hope you enjoyed this basic discussion. I'll have a couple coming up on estate and GST taxes, but for the time being, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of The 10th of an Hour, and I look forward to seeing you in the next one.